Turning on the recording. Today is Wednesday, October 7th. We are going to be focusing primarily on historical analysis. I had posted the lecture note for updated this morning that we're going to be covering as content in class today to the files section of ELMS. And that's what we're going to focus on today to set up our assignments for the upcoming weeks. A couple of things I wanted to make you aware of that were changes that I made, and somebody asked a question, is the exam open note? Next Wednesday's midterm exam is open book, open note. You'll actually need a computer because you'll be doing it on Excel, but it's no collaboration. It's an individual exam, can't get any help or assistance in any way from either a course assistance site, trying to search for past files, and or collaboration. That is not allowed. It would be considered an honor code violation. But yes, you can use your notes from the class. You can actually use some of the Excel files and homework assignments that you've done to help you do the exam. But otherwise, it is open book, open notes. Okay. So, but again, good lead in, segue to our next question. So I'm gonna go ahead and share my screen here and open up Zoom. So again, today we are going to be focusing on understanding the historical analysis, basically a CFI and ROIC tree, which is the next section of analysis based on the economic things that we have converted. But basically, go here to assignments. On Monday, we have to change this. Homework 6 is going to be due on Monday. So let me change this. I'm going to post it a little bit later today because I don't want you working on it during class, but it's going to be due on Monday, the 12th at 10 a.m. Okay, so I'm going to change that deadline here. So Monday, homework 6. And what homework 6 is going to be is it's going to be a company whose data I'm going to give you with an ROIC tree and a CFI, similar to the analysis that we do today. And you will write a minimum 500-word paper analyzing it using numbers, and that's going to be due on Monday for Monday's class. So Monday we'll have a Zoom, we'll go over that. Okay. Wednesday, which is 1 week from today, will be the midterm exam. It will be worth 10% of your semester grade, and you will take that during class time on Wednesday, October 14th. Now, unless you have an accommodation, which you scheduled with me in advance, you will take it during the class time that you are registered for. So this is section 201, the 2 p.m. class. So the exam will be available to you during your class time. So we'll open up at 2 p.m. You'll have to submit the exam by 3:30 p.m. I'll give you 90 minutes. And if you don't submit it during that period of time, you'll get a 0 on the exam. Okay. And so you have to take it during the class that you're registered for. So if you happen to be watching this on video, very important that you take this exam during the actual class time that you are registered for on October 14th. So again, if you're in the 2 p.m. section, 201, you have to take it at 2 p.m. All right, if you were in the section 101, you'd have to take it at 11 a.m. So it's based on what you're registered for when the exam will become available. The midterm exam will just be an economic statement conversion. It'll look a lot like homework 5, right? So basically you'll download an Excel file. You will convert the Excel file. In the Excel file that I give you, you'll create the 4 new tabs. You'll upload the Excel file, and that's it. There's no write-up. It's just a conversion, and you'll be graded on that work. Now, you cannot use any other Excel files to help you do that. So for example, if we see references to other files, or you submit a different file than the one that I give you, that's a 0 on the exam, and it'll be referred to the Honor Council as a potential honor code violation. So a few years ago, some enterprising students tried to create a solver for the exam. So basically they'd enter in data into a spreadsheet and it would spit out a correct solution. That is a complete academic violation and can't use that. So as a result, I don't let anybody do anything to corrupt the process and use anything but the exam file that I give you. So again, the exam doesn't have a write-up. It's just a conversion. You have to download the Excel file I give you. You have to add tabs in the Excel file I give you, and you have to submit the Excel file I give you. There is no reason to create any other file, by the way, but that is going to be the exam in class next Wednesday. Okay. So see the chat here. Let's see. Can we look at our Excel file we did in the previous homework? Yes, you can. So again, you can use things that give you the semester, including your homework assignments and grades, to help you do the exam. The only thing you can't do is you can't build a solver in advance, you can't get collaboration, and you can't use other files to help you solve it and link to those files, okay, which is very important. Okay. So with that in mind, to help you prepare for the midterm next Wednesday, in the file section, I have placed a practice midterm with a practice midterm solution. So this was a midterm I gave a few years ago, and it's an actual midterm. So you get a good sense of what it is. So, and basically I give you two files, the midterm and the solution. So my sense is, my recommendation is do the midterm without looking at the solution and then do the solution. And then again, the only big difference between this and the actual midterm, you'll have 90 minutes. Okay. So you have to do it during that class time next Wednesday. This isn't for a grade, just making it available. I'll give one more practice midterm on Monday as a final practice leading up to next Wednesday's midterm exam, but that is the midterm. So no other questions, it's just the practice midterm, okay? And so I'll quickly share my screen differently, share my desktop. So for example, if you look here in Excel, this is the practice midterm. See this file. So your exam will be slightly different format, but it'll look something like this. But basically, here's the income statement, here's the balance sheet. I will give you the 1, 2, 3, 4s, and so you will have to convert it. Okay. So again, create the tabs, do the conversion, upload it back, do it within 90 minutes, midterm exam. Okay. So then, because of the Bloomberg guest visitors, what I did is I had to move out group case 2. So group case 2 will be due, instead of this coming Monday, it will be due the following Monday. So group case 2, you can see this here, is going to be due Monday, October 19th. So that's the change. That was originally the date for homework 6. Now that's moved up a week, and group case 6 has been moved back a week. And so what group case 2, the group project historical analysis, will be is you will do a PowerPoint presentation, no write-up. You'll have 10 minutes, just like you did with group case 1. You'll present it during class that day, and it will be a historical analysis of CVS. So I will give you in class on Monday the statements, the ROIC tree and the CFI for CVS, and you'll have a week to basically analyze as a team and deliver that analysis in class for grade, 10% of your grade, Monday, October 19th. Similar format to what we did with group case 1. Okay. So those are the logistical changes you need to be aware of what's coming up. Again, questions about any of that?
Yeah, so for homework 6, are we going to go over like that today? Because I saw there was like no content on ELMS. And that's
yes. So I'm going to give you we're about to go through lecture 4, which is the PowerPoint presentation that gives you everything you need to know to do homework 6. The only thing I haven't done is I haven't made the homework 6 publicly available because I don't want people working on it during class. So as soon as class is over, homework 6 will be posted, and then you'll be able to work on it due Monday.
Okay, thank you.
Sure, good question. Final questions before we jump in. So again, I'll start with lecture note 4. All right, so again, I'm going to go ahead and share the PowerPoint. Okay, so basically the second section of analysis that we're going to do is based on the converted statements that you've been working on, okay? And there are 2 statements which we're going to cover in class today, which is part of your homework and upcoming group project. One will be what we call the ROIC tree, which explains the drivers of ROIC. The second will be the CFI analysis, which is historical CFI interpretation, okay? And drivers of CFI, right? So I like to say that you can't drive a car looking in a rear view mirror because the past doesn't guarantee the future. However, we do need to look at our past to understand where we're going. And we do some scorekeeping. And so we will keep track of how we're performing in the past. So again, the past look back is the second section that we're covering in equity analysis. And so part of the look back will be building these ROIC trees, which is basically an explanation of changes in ROIC over time. And what you're going to find out mathematically is there are three drivers that explain changes in ROIC. Always three drivers for any company, and we will start by talking about those. And then there's going to be two levels of analysis of those drivers that you'll always do, the first level and the second level. And so the items on this PowerPoint slide are what you're going to have to cover in your write-ups. It's also very important that you use numbers, because if you use statements without numbers, just like an EIC, you don't get credit, okay? Very important to use numbers. And you'll see exactly what I mean as we get started. And I'm going to start by analyzing McDonald's. So this is an ROIC tree of McDonald's. Now I've used the historical one because I actually think there's some good insight in here, and then we'll look at a current one for a company in just a few minutes. But this is a 5-year change in a company's ROIC. Excuse me. And start with the EOY, which stands for end of year ROIC, as opposed to BOY. And so to read this table, going from left to right, we see that in 2010, McDonald's ROIC was 21.8%. 5 years later, in 2014, it was 18.9%. That is a 5-year change of negative 13.6%. So as we get started, we're going to start with the beginning and the end, kind of consider the training wheels, but eventually you're going to be responsible, particularly by the time we get to the group case, of what's going on in between, and more importantly, relating it to the real world. All right, but today, really just focus on the numbers as we introduce this, beginning and the end. So ROIC went from 21.8 to 18.9, 13.6% drop. Why? There are three reasons. 1, 2, 3, always three reasons that explain the ROIC. So those are the three drivers that will explain that change in ROIC. And so we will always talk about all three for every company. So the first driver is what's called the cash tax rate. So in 2010, McDonald's paid a 29.3% tax rate. In 2014, it paid a 35.5% tax rate. So the tax rate was higher in 2014 than it was in 2010 by 21%, 20.9%. So a higher tax rate, paying more in taxes, lowers your ROIC. So the first driver, the cash tax rate, basically says that the ROIC should go down. So it was one of the reasons why the ROIC went down. Okay, so that's the first insight that we have. Now, if we take out the tax rate, we're left with the pre-tax ROIC, after-tax ROIC, pre-tax ROIC. So pre-tax ROIC times 1 minus the tax rate is the after-tax ROIC. So this is the underlying business of McDonald's, the pre-tax ROIC. In 2010, it was 30.9%. In 2014, it was 29.2%. That was a 5.4% drop in pre-tax ROIC. Okay? So why did the underlying business get worse over the 5 years? Well, driver number 2, operating margin. In 2010, EBIT divided by sales, which is known as the operating margin, was 31%. In 2014, EBIT divided by sales was 29%. That is a 6.7% drop over the 5 years. Okay, so 2% less, 2 percentage points less in operating margin is another reason why the pre-tax ROIC went down and the after-tax ROIC went down. Okay, the third driver is invested capital over sales. So what's actually happening with these two is this times this equals this. Okay, so profit divided by sales times sales divided by investment equals profit divided by investment. All right, that's just algebra. And that gives us the drivers of ROI because the S's cancel out. And this multiplication sign says they have equal weight. So this is P over S, this is S over I. This times this is this, ROIC. Then take it after tax ROIC. Drivers, these are the three drivers, multiplication. Now, the only difference is this is actually listed as invested capital over sales. This is sales over investment. So this is a reciprocal. Here, I'm doing I over S as opposed to S over I. And the reason why is I want this whole tab in Excel, which eventually it's created it, to be based on sales. So it's everything is a percentage of sales as opposed to a percentage of investment. So it's just reciprocal. So this times 1 over that, which is this formula over here, equals this, okay? So this times the reciprocal of this equals that, the way the actual data plays out. But these have equal weight, times this equals that. So these three are the drivers of ROIC. So back to this. Operating margin for McDonald's went down by 2%, 31 to 29. That hurt the pre-tax ROIC. What happened with productivity, which is another word for this? In 2010, here's the way to read this. To generate $1 of sales, McDonald's invested $1 of capital, 1-to-1 ratio. In 2014, to generate $1 of sales, they invested 99 cents in capital. That 1.4% drop is an improvement in productivity. So essentially, McDonald's in 2014 is spending less capital to generate the same amount of sales. That helps the ROIC, okay? Because you're spending less investment, same amount of sales, and therefore higher ROI. But in terms of the overall drivers, that didn't help it as much as the drop in the operating margin hurt it. And so therefore, net, the pre-tax ROIC still went down by 5% from 31 to 29, right? That's what we learned by doing what I call the first level analysis. These are the three drivers. Tax rate hurt them, margin hurt them, invested capital slightly helped them, but generally these two outweighed the third. Questions about that?
So for the homework, we'll have to basically say, like all these things, like $1 of sales equal $1 of investment, and that's why, and its ROIC went down by 1.4. Like get all the percentages and stuff, and then word it.
Exactly. That's exactly right. That's exactly what you have to do for your homework. Matter of fact, I think this will work because we're on Zoom. Let's say you're in Word. A nifty feature of Word, hit dictate. Just start talking. So in 2010, McDonald's ROIC was 21.8%, period, space. In 2014, McDonald's ROIC was 18.9%, period, space. That was a 13.6% drop in ROIC. That's what should be written. Obviously with spell checking and the dictate function, I'll turn it off, isn't working correctly. But like that's your paper. And you must use those numbers. Because if you just say McDonald's ROIC went down over 5 years because the tax rate went up, well, great, you might be technically correct, but you're getting a 0. I don't care how many words you write. That's what I've been talking about all semesters. Must use numbers as you go through this assignment. Other questions about the first level of analysis? Excuse me. Second level analysis. What drives operating margin? It's the income statement. So the items over here to the right are the items on the income statement that lead to the operating or EBIT margin. Gross margin minus SG&A minus depreciation equals operating margin. So this minus this minus this equals that. Okay? Those are the three things that explain your change in operating margin. So why did the operating margin go from 31 to 29? Well, let's start with the gross margin, which is the difference between price and cost as a percentage of sales. So it went from 45 to 61. Big jump in gross margin, 35%. In 2010, the SG&A, they spent 9 cents per dollar in SG&A. 2014, they're spending 26.5 cents per dollar in SG&A. Big jump in SG&A. Depreciation as a percentage of sales, 5.3 to 6. That went up 13%, but the magnitude was not as nearly as big as the first two. So it's gross margin, SG&A jumps. Now, here's where I say we're just doing beginning and end, but the middle years really do matter. Because if I look at McDonald's gross margin, 45, 45, 62, 62, 61. Look at the SG&A, 9, 8, 25, 25, 27. Like something's going on between 11 and 12. This is an apple, this is an orange. And so the reason why I like to leave McDonald's as an example is because McDonald's reclassified under accounting standards some of their costs that were in cost of goods sold, they moved them to SG&A. So 2010 and 2014 in gross margin SG&A really are not comparable. And so if you tried to do this analysis, it wouldn't actually make sense. So really what's more comparable is 2012 to 2014. That is more comparable. And if we look at the 5-year operating margin, 31, 32, 31, 31, 29, it was really the drop between 13 and 14 that was more precipitous. So if I really try and understand the second level analysis, what's going on in the income statement, it's these last couple of years that matter anyways, as the gross margin went from 62 to 61.4. So basically 2 cents, 0.2% here. SG&A went from 24.8 to 26.5. Much bigger jump in SG&A. Depreciation 5.6 to 6. So all three of these worked against McDonald's in the final year. Slightly lower gross margin, bigger jump in SG&A, bigger jump in depreciation, all led to the decline in their gross margin by about 2 cents in 2014 versus 2013. The biggest driver being the increase in the SG&A. What's going on in the balance sheet? Because productivity, invested capital is the balance sheet. 3 parts of invested capital: operating working capital, property, plant, and equipment, intangibles, which is spending on goodwill. Take all 3 of these as a percentage of sales, add them up, you get that number. Operating working capital plus PP&E plus intangibles as a percentage of sales equals invested capital to sales. Add these 3 up, you get this number. So why did they go from spending $1 to 99 cents? Working capital went from -2 cents to 0, right? Even though it's negative, it's less negative. Basically, you have more payables than assets. Basically, it's less negative, which means they invested in working capital. So this hurt the invested capital sales. It's not why it went down. PP&E to sales went from 91.6 to 89.5. That's the benefit, is the building, lands, equipment, stores, and stuff inside them. That got better by 2%. And more importantly, 2 percentage points. Intangibles to sales went from 10.7 to 10. That also improved, -7%. So if I really look at what's going on at McDonald's, I had working capital and PP&E kind of offset each other. The benefit they got in working capital was offset. The worsening of the working capital, I should say, was offset by the benefit they got by their PP&E to sales. They just kind of cancel each other out. And then the extra spending on extra benefit by having less intangible to sales drove the invested capital sales down. Okay, so what's the headline? Now that I've worked through my second level drivers, I work backwards. What explains the overall change of end of year ROIC? On the income statement, it was primarily the SG&A, which went from essentially 24.8 to 26.5 in the last year, which drove the operating margin down from 31 to 29 as the primary driver, while maintaining similar productivity, invested capital sales $1 to 99, because basically on the balance sheet, the improvements in PP&E from 91 to 89 were offset by the increases in working capital from -2 to 0, which led to a decrease in the pre-tax ROIC going from 31 to 29, and a slightly higher tax rate of 29 to 35 led to an overall drop in the ROIC from 22 to 19. That is a CFI. That is an ROIC tree analysis. Questions about any of that from McDonald's?
Right. So when we're doing the operating working capital, PP&E, and intangibles, we add those up first and then divide that sum divided by sales to get.
Well, each one of those is a percentage of sales already.
Yeah.
So basically, what I'm saying is if you add those three numbers, working capital to sales, PP&E to sales, intangibles to sales, you get invested capital to sales.
Oh, okay.
So those three added up equals this one, this
Yeah.
same thing. This minus this equals that. So these explain that. These explain this. Drivers. That's why we call them drivers. Other questions about the McDonald's analysis we've done so far? All right, same period. Let's look at Chipotle. So this is Chipotle, burrito place, 2010, 2014. So 2010, Chipotle's end of year ROIC, 26.6%. 2014, 40.8%, an increase of 53.3% over the 5 years. Why did Chipotle's ROIC go up so much? Well, first driver was cash tax rate. The cash tax rate went from 38.1 to 37.6. That's a 1% decline in tax rate. Helped them a little bit, but that's not the primary reason why the ROIC went up over the 5 years. The primary reason is because the pre-tax ROIC. The underlying business got better because the pre-tax ROIC went from 43 to 65, right? Why did that pre-tax ROIC go up by 52%? Well, if we look at one of the drivers was the operating margin, which went from 15.7 cents to 17.3. They were making more profit every time they sold something by increasing it by 10.4% over the 5 years. Their productivity went from spending 36.5 cents to generating $1 of sales to spending 26 cents to generate $1 of sales. They got more efficient. They're spending less capital to generate sales. Both of those improved their ROIC. Okay. Now the invested capital improved it more. The 27% drop, going from 36 to 26, the 10-cent drop overall per dollar of sales, actually probably impacted it more than the 2-cent improvement in operating margin, the 10% improvement. All right. But both of those were favorable at driving down their pre-tax ROIC while they paid slightly less in taxes. So all three, operating margin, productivity, and cash tax rate, helped their pre-tax ROIC go up. That is your first level of analysis. Your second level of analysis, gross margin during that 5-year period of time went from 30.4 to 29.9. Slight decrease in gross margin by almost 2%. That hurt their operating margin. SG&A went from 11 to 9.9. They basically spent 1 cent less on SG&A. And depreciation went from 3.8 to 2.7. So it was a combination of a penny per dollar less of SG&A, 1.1 cents per dollar, so there's 2 cents there for depreciation, offset by a slightly lowering gross margin is the primary reason why their operating margin went up. They got more efficient with their SG&A depreciation particularly. Then finally, we have invested capital to sales. What's going on in their balance sheet? Well, working capital went from essentially negative 1.6 cents to 0. So they're spending money on working capital. It's getting less negative. That's not helping their invested capital to sales. All right. What is helping them is PP&E went from 36.9 to 26.9. They're spending 10 cents per dollar less on PP&E. These are the days when Chipotle would open up the store and lines would be up around the block, okay, before the E. coli scandal. And intangibles, they barely spent money in acquisitions. They had 1 cent of intangible to sales in 2010. They had half a cent in 2014, slightly better on acquisition productivity. But essentially, it was a big change. It was a small amount. 55% change matters less. The fact that there's only half a cent here. But the key here is it was about the PP&E to sales. So when I think about the drivers, it was the big improvement in what I'll call store productivity, PP&E to sales, going down by 10 cents per dollar. That led the capital to sales to go from 36 to 26. And the improvement in SG&A and depreciation as a percentage of sales, going from 11 to 10 and 4 to 3, that drove their operating margin up 2 points, 2 percentage points, right? That led to the big increase in pre-tax ROIC from 43 to 65, with a slight increase in tax rate that drove the after-tax ROIC from 26.6 to 40.8. Work to the right, summarize, drivers go to the left. That is your ROIC analysis. Again, I'll pause for questions. Let's go with more current data. So this is Walmart. And this is through January 2020 when they reported their results. So right before the crisis. 5 years worth of data, same type of analysis. I'll give you a minute or so to look at this. And then I'll ask if somebody wants to volunteer to go through it, but we're going to go through Walmart next. So, excuse me, this is closer to your homework because this will be current data on a company. All right, does anybody want to take a shot at Walmart? First level analysis?
I can try.
Okay.
So Walmart's ended the year ROIC went down from 12 point, in 2016 was 12.8, and in 2020 was 10.6, which is a drop of 17.1%. This can be explained by even though the cash tax rate drop of 19.4% helps them, their end of the year pre-tax ROIC explains why their end of the year ROIC dropped, with the operating margin of 5 cents per sale dropped to 3 cents or 4 cents, which is a drop of 21.5%. And while their invested capital on sales increased by 2.7%, this explains why the end of the year ROIC dropped from 18.4 to 14.1%, which is a 23.5% drop.
Okay,
So
let's just stop right there. So I think you got the highlights of a lot of the first level. So I just want to make two observations. So good first try. First comment I would make is you need to make sure, as he is doing, that you're able to connect the dots yourself, that you understand what the relationships are with these numbers, and that if one changes, why it changes with something else. So that's the first thing you need to do, and that's something you did, okay? And you have to also make sure you use numbers along the way. It's not easy to do. You'll keep getting used to this. So you did it really well when you started. You kind of skipped over it when you went to the pre-tax ROIC, and then you started using numbers again in the back, because you can't just talk about the percentage change or one's getting better. But the other thing you got to remember is that when you're explaining this to somebody, even though it's connecting in your mind what you're looking at, you got to connect it in their mind too. So when you get to your group project, make sure that you're just not spouting a bunch of numbers, that you're helping me make the connections that you're making. Because what might look like an obvious connection to you may not be obvious to the person that you're explaining it to. So it sounds like, well, do I have to be really didactic and slow down and explain it? Yes, you do. And that's going to be important to analyzing this. So again, when you say things like the tax rate helped them, you need to add to that statement and say, because it went from 30.3 to 20.4, 24.4, and the lower tax rate, which was a driver of the ROIC, went down. And just adding that extra context helps people who may not be as familiar with these statements, number one, show what's actually being linked together, and number two, help them make sure that they understand the connection that you're making, okay? Because just saying that the cash tax rate went down and I'm gonna move on to the next driver, well, I don't know what that means. You're just reading two data points to me. So there's a difference between just reading data on the slide and analyzing data on the slide. And I'm just highlighting that as you guys are doing your analysis, both in writing and verbally in a week and a half. Okay, but otherwise, he hit the highlights. I could see he was connecting the dots, and that's a good practice for a start, but that's why we're gonna start doing assignments. Questions about any of that? All right, somebody want to try and explain the change in operating margin? Second level drivers of the income statement that explain change in operating margin.
Yeah, I'll go take a stab at it.
Go ahead.
So you can see the gross margin. It's decreasing from 27 cents to 20.268, which is about a 1% decrease, which is hurting it, but not by too much. It's mostly getting influenced by the SGA and the depreciation. The SGA fell from 0.201 to 0.208, which was a 3% drop. And the depreciation had 0.020 to 0.021, which was a 6.9% drop. Well, I mean, it would increase in SG&A and depreciation, but it dropped the operating margin.
Okay.
So all three of them kind of work together.
So basically just, yeah, it's easy to get jumbled up. So when you said drop SG&A, what you probably meant was that the operating margin was dropping, but that's an increase in SG&A. So
yeah,
I think I know what you were saying, but technically you said it incorrectly. So
yeah, I heard myself after I said that, and I was like,
but that's what I said. There's a lot of data on these slides. And that's actually just a good point. Like when you're trying to explain this stuff, it's almost like you got to slow down and not go too fast, because you almost get ahead of yourself because you know what you're saying and then you forget. So just a little practice in this, particularly when you're doing your presentation, because I'll be sympathetic to this now, but if this is the group project and somebody says that by mistake, you will lose points. All right. So again, but he had it right. And I knew he had the intention right. That was the more spending in SG&A dropped the operating margin, which is what he was trying to link. And that's the correct link. That all three of those, gross margin, SG&A, depreciation, kind of working slightly against Walmart as their operating margin went from 5 to 4. And when you're making a 5% margin, going to a 4% margin, that's a big drop of 21%. And those were the drivers of the drop. What's going on in their balance sheet? Someone take a shot at the balance sheet, invested capital to sales.
I could try it.
Okay.
So they are spending less on operating working capital, so that's why there's an increase in percentage change. They were spending, well, so the spending went down from 2016 to 2020, and then for PP&E and sales, it went, in 2016 it was 0.242, but in 2020 it was 0.243, so it's a 3% increase, which is not good. Well, basically operating working capital has the most impact on invested capital sales, because that decrease in spending is helping their ratio, but the other two are a less of an, I got lost.
That's okay. You're trying. So again, let's just break these down independently. So let me just ask you this. Working capital, going from essentially 0 to -2, better or worse?
Better.
Better. You got better by how much?
-2.
About 2 cents, round off. Okay, that helped the invested capital sale. What happened to PP&E? Did it get What happened between 16 and 20?
It basically stayed the same, but there were changes in between.
Okay, but overall over 5 years, I'm just looking at beginning and end, stayed about the same. But you're right, changes in between. What happened in intangibles between 16 and 20?
It went up
By
like 0.2.
okay. So if Walmart got slightly worse, what was the primary culprit?
The intangibles.
Exactly. That the spending on the intangibles going from 3.5 to 5.9 offset the improvements in working capital going from 0 to -2. And that caused the invested capital sales to get slightly worse from 0.27 to 0.279.
Got it.
But the headline is that it's not about productivity, which is why Walmart's ROIC is getting worse, right? It's the slight worsening of productivity, spending a little bit more because acquisitions hurt them a little bit, but it's primarily the drop in operating margin that really hurt our Walmart's pre-tax ROIC. And that's what I would want you to kind of conclude here. And actually the tax rate should have helped them. That kind of mitigated some of those effects. Questions about Walmart?
I just have a question if you will be giving us this tree or will we be constructing the tree ourselves before going into the information?
For homework 6 and for your group case, I will be giving you the tree.
Okay.
Post midterm exam, you will be creating the trees yourself when you build the evaluation models.
Thank you.
Okay. Other questions? All right, and then just for fun, if you wanted to compare Walmart against somebody, 2 slides down, this is Costco, similar 5-year period. So Costco 2015 to 2019, here's how Costco had done. What you'll notice about Costco as a top line is Wall Street loves Costco. They're the most predictable company out there. Year over year, they just churn out the same numbers. They're really easy to forecast. I'll give you a sense of this. So their end of year ROIC went from 18.9 to 22.4. It was an 18.5% increase. But primarily for Costco, it was about the reduction in tax because the tax rate went from 33 to 22. So the 32.8% decrease in tax rate, and if you look at the pre-tax ROIC, it's the primary reason why their after-tax ROIC got better because the pre-tax ROIC went from 28.2 to 28.8. So it barely changed over the 5 years. And so if I look at the 5 years, the operating margin, the reason it didn't change, 3.1, 3.1, 3.2, 3.2, 3.1. They're as predictable as a clock. Invested capital to sales, 11, 13, 11 and a half, 11, 11. With the outlier of 2016, they spend 11 cents on the dollar on capital, they make a 3% margin, and they do it every year. Now, if you look at their gross margin, 14, 14.4, 14.3, 14, 14. This is actually why I like Costco as a customer. You to go into the store and you know that they have a low markup on all their merchandise. They have a very low gross margin. It's pretty consistent in everything they sell. So customers like it as well. Actually, this is the criticism Wall Street has of Costco. It's not that they're too predictable. Wall Street thinks they don't charge enough, right? But nonetheless, SG&A, again, 9, 10, 10, 10, 10. Very predictable spending in SG&A, very predictable gross margins, depreciation. Penny, 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 penny. So again, their income statement, if you think out 2021, 22, it's relatively easy to predict, right? Because it's almost like consistency year over year over year. Working capital to sales went from -2 to -2.9, got a little bit better. PP&E to sales, 13 cents to 13.7, got a little worse. He's offset. No, they don't do acquisitions, no intangibles, okay? So again, just in the interest of time, I'll cut it short, but that's Costco. They're just a slightly different company than Walmart. You can even see in the margins. They're a lower margin firm. Walmart's always low prices. Costco, even lower prices, right? And you can see that in the way that their statements are set up consistently. All right, that's statement number 1. That's the ROIC tree. That's half your analysis. Again, approximately 250 words or more. In the paper that you're going to write individually for Monday on a different company. Let's go to statement number 2, CFI. Okay, you've converted the CFIs. Now you're going to explain the CFIs. And unlike on homework 5 in the midterm on made up companies, we're going to do it with real CFI data. Okay, and there's 4 sections of the CFI: free cash flow, non-operating cash flow, debt cash flow, equity cash flow. We're going to explain all 4 and the main changes in each one. Okay, and these will be the drivers that you'll see as we go through this. So I'll start historically again with McDonald's. So here is McDonald's historical data. Make it slightly bigger. Zoom in some more. All right. When you analyze free cash flow or CFI, you always start here with free cash flow. Now, the way this statement will work is I'll give you 5 historical years, and then the total is literally just that. It's the sum of the 5 years. Now, again, when the training wheels are on today, we're going to talk about the total column, right? But eventually, by the time you get to your group project and beyond, you'll be also responsible for the trends in between. Okay, so here's the point. Let's look at what's going on with Costco, or sorry, with McDonald's. Right. So first step, free cash flow, total column, 23.9 billion of free cash flow over the 5 years. We start with free cash flow for another reason, because it frames the way you'll do your analysis. If the free cash flow is positive, you need to explain why it's positive, and more importantly, where did the money go? If the free cash flow is negative, you got to explain why it's negative and where did they borrow the money? Because that's the point. If they have a positive free cash flow, I know they're distributing it. Where are they distributing it? That's the other half of the analysis. If it's negative, I know they had to go find the money to fund the losses. How are they funding those losses? Where is that money coming from? So it just sets up the analysis that you're doing for the company. So in this case, why is McDonald's generating more cash than it spends? Well, gross cash flow is the cash for the income statement. 35.5 billion of gross cash flow over 5 years. They reinvested 11.2 billion, which is a 31.7% reinvestment rate, which means 32% were reinvested, 68% was theoretically available to be paid out. Right? So let's look and see what's going on here, right? So a little bit more detail, right? What was the reinvestment rate over time? It was 34, 29, 49, 34, 11. So generally it looks like it was in the 30 to 40 range, and then it dropped precipitously in 2014. Interestingly, it dropped as the gross cash flow went from 6.5 to 7.2 to 7.3 to 7.5 to 6.7. So as the gross cash flow was dropping, so was the reinvestment. Just a clue for us to come back to later. The other thing is between free cash flow and free cash flow excluding goodwill is spending on goodwill. This is spending on acquisitions. $300 million in acquisitions over 5 years, very little money spent on acquisitions by McDonald's. So 24.2 billion of free cash flow before acquisitions, goodwill, became 23.9 billion total free cash flow to distribute. The other key number to look at is the ratio between depreciation and CapEx. Okay, so basically what we're going to do is we're going to take, so I'm trying to actually draw this with my mouse, CapEx, and we're going to take that and we're going to divide that by depreciation. And we're going to look at it as a ratio. So just here's what I mean. Here's depreciation. Depreciation is straight line according to GAAP for public statements, which means I take whatever I spend in the asset and I spread it out equally over time. Assumption we make in finance. A company has to spend its depreciation to tread water. Basically, if I'm not going to see my business crumble, I got to put some maintenance to maintain what I got. Spending depreciation maintains my current level of facility. Doesn't allow me to grow, doesn't shrink. I just kind of stay the same. That's just an important assumption that we make in finance. Okay, I'm not saying it's always true, but just something to think about. Okay, so if I am spending more on CapEx than on depreciation, probably trying to grow. If I am spending less on CapEx than depreciation, not trying to grow, probably trying to shrink, or I have excess capacity. So here's the point. What is the ratio of CapEx to depreciation in 2014 for McDonald's? And what is the signal of this number? Because the idea is if I spend CapEx this year, I'm probably using it to build something that I'm going to start selling next year. So what does this ratio suggest? For McDonald's in 2014, CapEx to depreciation.
Capital expenditures decreased immensely from 2013 to 2014.
Not just that they absolutely decreased, but what does the ratio suggest?
Well, now it's like a quarter. Like
Are they expecting to grow?
probably not by as much.
Or at all? If I have $400 million of CapEx and $1.6 billion of depreciation, I'm not coming close to replacing what I got. In fact, let's look at the trend over time. Depreciation $1.3 billion, spend $1.8 billion. Depreciation $1.4 billion, spend 2.2. Depreciation $1.5 billion, spend 3.3. Those are all growth signals. I'm trying to grow. Open up new stores, spend money on new equipment. $1.5 billion to 2.6, still trying to grow. $1.6 billion to 400. I'm noticing some red flags here very consistently. Drop in gross cash flow, reinvestment rate goes to 11%. They're spending a quarter of depreciation. McDonald's knows that they're having trouble at this point with their menu. This is the period of time, a few years ago, when McDonald's was actually starting to wonder about, is it healthy food? Is our food healthy, or should we even shop here and eat here? Are their prices too high? The dollar menu was being reintroduced. They were starting to have some trouble. And I'm telling you that you could actually start to see on their statements potential signs of trouble. Now, hindsight is 2020, but still, there's some potential questions about, hey, McDonald's, why are you slowing down your CapEx so much, so dramatically? What is your signal that you're looking at for next year? We're noticing your gross cash flow is dropping, right? Why is the gross cash flow dropping? We just did an ROIC tree analysis where we saw the operating margin went from 3 cents, 3.1 to 2.9. So they're getting less margin in the business while they're slowing down the investment, and we're seeing that on the cash flow spigot tightening up. So we can start combining these two to get some insights into what's going on, ask some more questions. But that's the free cash flow analysis that we start with. Make sense? Questions about any of that? All right. Section 2, we then go from free cash flow to CFI. So what's happening with the non-operating cash flows? Well, McDonald's generated $1.097 billion by selling off some non-operating assets. They put $188 million in the bank for excess cash, and they increased it. And they also had a non-operating loss of 151.8. So they ended up with 24.7 billion, 7.5, so 24.8 billion of cash flow to pay out. That was higher than what their original free cash flow was. The non-operating cash flow added about, call it 800 million of cash to pay out to get to 24.7. Then we go to the financing. What did they do with the 25 billion? Where did it go? So we got, again, 25 billion. How did they spend that cash? Well, they put $1.7 billion to pay out interest over time. Okay, makes sense. Got debt, got to pay interest. Next, they increased their debt by $4 billion. Now, I want you to think about that. McDonald's has $25 billion worth of free cash flow. That's billion with a B. And they borrowed $4 billion in new debt. Why would they want to do that? And I'll treat that as a rhetorical question for the time being, because they clearly don't need to borrow that money. After they reinvest, they still got 24 billion left. They're generating cash flow of almost 7 billion a year. They clearly don't need this debt. So why are they borrowing $4 billion worth of debt? Well, They're paying $14 billion of dividends, and they repurchased $13.6 billion worth of common stock. By the way, if you add these two numbers up, 14.2 and 13.6, that's 28. $28 billion of payments to shareholders, and they had $25 billion of cash to pay out, which is really $24 billion of cash from operations. So if I have $25 billion of cash to pay out, how do I pay out $28 billion to shareholders? I borrow $4 billion worth of debt. It is really clear that McDonald's was actually choosing to increase the debt to pay it out to the shareholders. They weren't doing it for acquisitions. They weren't doing it because they needed it to invest in their stores or generate enough cash flow to do it. The only reason for the debt was basically to, in their words, reward the shareholders. But what I would say is this isn't confidence in the business buying back the stock. This is basically manipulating earnings per share because the underlying business is having trouble. We know from the ROIC analysis that their margins are slipping. We know from the CFI analysis they've stopped investing in stores. We know that they're potentially having some growth issues. So therefore, the reason they're buying back the stock is to basically make it look like a better story than it is. This is not sustainable. All right. And don't get me wrong, they can pay out $24 billion of cash over time. They can pay out a good $5-6 billion a year, but they can't keep paying out at this rate because eventually the banks are going to say no. But a lot of companies do this. They took advantage of cheap debt to basically borrow the money to buy back the stock. But that's clearly what they were doing here. And that's insight we get by doing the CFI. We also get some insight that they were having some potential challenges. Questions?
So did the issuance of stock that they have, did that play any role either in like raising money for those for the dividends they had to pay out and such?
So they were definitely issuing some shares of stock during this period of time, and then obviously selling it. So why? Don't know. We'd have to do some, that's a good question to investigate. We're about to see a similar thing with Chipotle, and I'll give you my sense of this. One of the things companies do in general, and I don't know if it's 100% certain here, but it could be, is that to inoculate the shareholders from basically dilution of employee stock options. One of the things that the companies would do is the employees were cashing in their stock options, they would buy back a commensurate shares of stock. So that way the stock options that were being issued were not basically wiping out the shareholders, right? So that could be why they were issuing shares, basically cashing in the stock options to then repurchase them in the open market. But they repurchased a heck of a lot more than they were issuing, right? But nonetheless, sometimes the companies will issue stock and doing acquisitions, but they didn't really do acquisitions. But again, this is back to the quarterly conference call. For analysts, this is what we start asking about, right? What are you doing? Why are you buying back all this stock? Why do you really need that debt again? What are you really using it for? So again, get much more insight, but a good question. Other questions? Let's look at Chipotle at the same 5-year period. So again, this is pre-E. coli Chipotle. Okay? So again, same company we did the ROIC tree on, start out here, free cash flow, $970 million. They're not nearly as big as McDonald's. All right, what do we notice Chipotle? $1.874 billion of gross cash flow. Pretty much increasing every year, 250, 290, 361, 422, 553. 48% reinvestment rate. They reinvested $906 million of gross investment, nothing in acquisitions. Their reinvestment rate was 50, 40, 58, 48, 47. I'd say it's consistent, but it's in the 40 to 50% range pretty consistently, averaging 48%. Here's what I also notice. Clear every year spending more CapEx than depreciation. Spending 2.5 times depreciation here, spending double depreciation here. Chipotle was definitely not only in growth mode, they were signaling continued growth mode in 2014. So since McDonald's and Chipotle are competitors, as McDonald's is struggling in 2014, Chipotle is surging. So I'm not so sure it's just a market issue that's hurting McDonald's. I'm actually, now that I start looking at their competitor, I'm thinking that maybe Chipotle is part of McDonald's problem, is that people are moving away from McDonald's to other alternatives in the marketplace. Because otherwise, if it was a market issue, I would expect to see Chipotle experiencing similar problems to McDonald's. Okay. What did they do with the $970 million of free cash flow? Well, they turned it to $140 million of CFI. Why? Because they put $437 million in excess cash reserves. They added to their excess cash. They increased their non-operating assets by $397 million, and that led to about $139.7 available to pay out. They had no debt. Whatever debt they had, they wiped it out. They paid no interest. They had no preferred shares. They had no minority shares. They did buy back $630 million worth of stock. How many companies growing as fast as they were self-funding, put cash in the bank, and bought back their stock? Like, they were firing on all cylinders. This was the same Chipotle, if you remember, that was paying less in taxes, increasing their margin year over year, and improving their productivity on the ROIC tree. And so it was definitely giving them a lot more cash flow to repurchase. Again, they were also issuing some shares, probably to inoculate the stock option stuff, but again, for investigation. But here is a completely different story than McDonald's. Now, again, nobody knew that this was the Titanic about to hit the E. coli iceberg, which completely devastated their business. But regardless, it was doing really well up until that point. Questions about Chipotle?
I guess this is more of a general question, but
Mhm.
like, how is this, like, what is this data really used for? Because I guess in both like companies, like in Chipotle, you could forecast that it was going to do really well, and then McDonald's, you kind of thought it was going to do poorly, but then McDonald's had like the breakfast menu come back and they started doing really well again. So like, how do we use this data to, like, what is it indicative of in the future?
Well, again, it's not completely indicative of the future, but two things. One, it starts to set up the forecasting that we do, and it helps us. So for example, we have to forecast at this point 2015. Okay. So as I forecast 2015, if nothing else, I have a signal from Chipotle that they're expected to grow in 2015. I have a signal from McDonald's that they're not expected to grow in 2015. I have a signal from Chipotle that their margins are expanding and getting better year over year. So when I start forecasting, I'm going to think about that when I think about what their margins are going to be in the future. McDonald's, I actually start to see margin compression. So what am I expecting to see with them over time when I think about their ROIC tree and I start forecasting their ROIC? Again, the past does not guarantee the future, but they start to identify trends that are going on with the company. And even the comment of who's struggling, who's doing well. These are the scorecards that we actually use that will eventually drive value, and it's all based on cash flow. So that's the point. This is the understanding of the real cash flow that's going on in the company. So if you're McDonald's and you're saying, oh yeah, I'm buying back a lot of stock because I have all the confidence in the future of our firm, I call BS. Like, I'm looking at this and I'm like, no, you don't have confidence in the future. You had confidence in the future, you'd be reinvesting more, right? You're slashing your reinvestment, your profits are going down, you're buying back stock to cover that up. That is what I see in terms of what's happening in the business. Not every business is going to look that way, but I started to get insight into what's happening in the company. Same thing. Let's look at Walmart. This was the more realistic, real-time data. So here's Walmart this year. How is Walmart doing? Okay. Well, as we analyze Walmart, $64 billion worth of free cash flow, $128 billion of gross cash flow, $50 billion of reinvestment, 39% reinvestment rate. In the interest of time, I'll just show you a couple highlights. Look at the reinvestment rate, 28, 10, 31, 32, 94. Look at depreciation of 11 billion. Look at CapEx of 26 billion. Nothing like they've done in previous years. This signifies something major that Walmart is investing in. We know now it's called Walmart Plus. This is the Amazon challenge that Walmart is launching to basically scale up to do online in a much bigger way. They were ramping it up in 2020 to be able to do this in terms of their CapEx, which was technically 2019 because they were January 2020 firm, the last year. And you could start to see this ramp up. And so the point would be, we see this signal. So obviously, Walmart is expecting a surge in growth even before COVID-19 showed up. In fact, here's the other thing I noticed about Walmart. Look at their goodwill. They spent $13 billion on goodwill. I would expect that this is a group project. You would know who they bought because it's clear the acquisition was in 2019, which is 2018 in real time. Who'd they buy? They spent a $13 billion premium acquiring somebody. This is probably Jet and Bonobos when they bought those companies a few years ago, right? But that's the point. I'd expect you to know, who did they buy? Why did they buy them? What does that mean? So signal for depreciation, or sorry, goodwill, signal for CapEx, change in their business. This is a completely different story than what we're seeing at a company like a McDonald's with their business. So this is the type of insight I eventually expect you to have, because again, we really need to understand what the company is doing as we start to forecast it, because those forecasts will lead to trends. Now, obviously, the future is more important to valuation, but this is an understanding of what's been going on in the past. And it's a little bit more of a forensic view, and it's a cash flow view. And to be honest with you, it's a more insightful view than the way I think the accountants do it. But regardless, it's the way I'm going to make you do it this semester. Again, questions. If you're following Walmart through, 64 billion of free cash flow became 48 billion of CFI. They increased their non-operating assets by 11 billion. Wonder why? A lot of it happened last year. They also had a $6 billion non-operating loss. Right? With the 48 billion of cash to pay out, they paid out 8.4 billion of interest, borrowed 27 billion of new debt. They bought $2.3 billion of minority stakes in other businesses, most of it in 2019. So who are these joint ventures they're investing in? They paid out $2.5 billion in profits to those minority shareholders, paid 31 billion in dividends, bought back $34 billion worth of stock. By the way, that's 64. 64 is 64. They're paying out 100% of their free cash flow, right? But because of some of these other issues, they're having to borrow the money to be able to do that. But basically, Walmart's paying out all their free cash flow to the shareholders. Questions? Other questions? All right.
So do you want us to just get like the highlights of what we see through the CFI analysis in the second part of our homeworks when we do this and for our presentations?
The CFI analysis, I need you to cover all 4 sections always. Free cash flow, non-operating cash flow to get to CFI, debt cash flow, equity cash flow. Yet explain how you got to the totals in each of those sections. So those are the highlights. And those are the major categories. So if something changes by, and Walmart's scale, 53 million, I don't have to talk about that much. If something changes by 11 billion, that's something I probably should be highlighting because those are the major changes that are driving Walmart. But again, back to free cash flow. You got to tell me why they're generating 64 billion of free cash flow. So you're going to be talking about the reinvestment rate. You're going to be talking about the signaling effect of CapEx against depreciation. You're going to be talking about what's going on with their gross cash flow over time. And you're going to be using numbers along the way. You're going to tell me the story of the company. If it were Walmart, the story of their CFI. What's the story of their ROIC tree? And you use numbers to help me understand it, the relationship to what's going on.
Hey, Professor, could you explain the non-operating part?
Well, again, the non-operating is how you get from here, free cash flow, to here, CFI.
Yeah.
That's non-operating cash flow. So you start looking at the items here, right? These are the dashes mean no change. You don't have to worry about those. So increase, negative, non-operating assets. They spend 10.8 billion. You can see they've been spending 4 to 5 years. Biggest spending was in 2020. Again, For purposes of the homework, you could just say it went up by 10.8 billion. For purposes of your group project in a week and a half, you got 6 people on your team, spend a little bit of time looking through their 10K, read through the analyst reports, figure out what the heck they're actually investing in. You should know. Same thing with the acquisition. You can tell me with certainty that they bought somebody in 2019. We know that. So if this were your group project, I would ask you who they buy. I would expect you to know that question because you know that you should go figure this out. This is a pretty big acquisition. So who did Walmart buy? They're making a big bet on capital expenditures. If this were your group project, I would be asking you, why? What's the 26 billion for? You can bet the analysts have been asking that question. So it's going to be talked about in the analyst reports and the conference calls. So again, here for the homework, you're just going to explain to me the relationship to the numbers. That's your practice. But eventually, this is the story of what the company's doing because they're making decisions that are leading to these cash flows. And so we got to work backwards from the cash flows and the decisions. Other questions? All right. So again, reminders, if you need help on this again, you have the TAs to help you the next 2 days. They are available. In addition, in just about an hour or so, I'll post up homework 6, which we do Monday. I'll give you the CFI and the ROIC tree on another company, minimum 500-word write-up. That is an individual company. Make sure you use numbers, make sure you explain the relationships and cover all the levels of the tree, as well as the CFI, 4 sections of CFI, right? On Monday's class, we'll again go over this. I'll then hand out the CVS assignment, which will be your group project will be due the following Monday. Remember to take the practice midterm to work on the conversions for the midterm exam that's due next Monday, or sorry, next Wednesday during class, you'll take it. So you get to practice a little bit more with the conversions over the weekend, the conversions and the solutions. Okay. If you have any other questions, let me know. Otherwise, that will end class today, and I am ending the recording. Have a good day, everybody.
Could I ask a question off the recording?